So we are starting with the topic called NPV. Now, what is NPV? See, when you will start a project, of course, you will do some investment. Let's say you have invested $100,000. That is your initial investment. Now, when you invest your money in some project, let's say you have bought a machine like worth $100,000, and that machine you will be using for manufacturing purpose. You will be converting raw material into finished goods, and those finished goods you will be selling in the market. Okay, and as you will be selling those goods in the market, you will be generating revenues out of it. Fine. And those revenues can be termed as your cash inflows. So now I will come to this here. This is my investment, $100,000. And this is like a negative figure, because this is a investment, it's an outflow, and every year you are expecting some cash inflows for 5 years, let's say. Okay, so you are expecting the cash inflows in this way: $10,000, $20,000, $30,000, $40,000, $50,000. Whether you should whether the machinery what you bought, okay, for your company has been a profitable deal for you or not. That means with the usage of this machine, you are generating some revenues. Okay, just a second. With the help of this machine, whatever the cash inflows you are generating, whatever the cash inflows you are generating, whether those cash inflows are the ones which considering your returns included in those cash flows. Okay, of course those cash flows are going to be the future cash flows. This you are going to receive at the end of the first year, this you are going to receive at the end of the second year, third year, fourth year, and fifth year. And you know the method what we are speaking about is NPV, which considers time value of money. As you know, today what you have is not worth tomorrow. Today what you have is more important today than tomorrow. So that concept we have already discussed. So these are the future cash flows. Of course, your returns are hidden in that, because these cash flows are with your expected returns what you want. So we will remove the returns from all these cash flows, what you expect, and then we'll try to find out the present values of these cash flows. And we will see whether the cash flows, the cumulative present values of all these cash inflows of the future, cumulative is nothing but you're going to add them up. So that will become cumulative cash inflows. Okay, cumulative present value of the cumulative of the present value of cash inflows of the future. That means you will be adding up all the present value of the future cash flows as on today, and you will be finding out the present value of all these 5 cash flows as on today. And then you are going to compare that present value of future cash flows as on today for all these 5 cash flows with the cash outflow. If your present value of cash inflows, the total of present value of cash inflows of all this future cash flows what you're seeing on the screen is more than the outflow, then definitely this particular machinery has given you more than what you wanted. Okay, that means you were successfully able to recover the entire amount what you invested, and you have surplus with you. That means NPV is nothing but present value of cash inflows minus present value of cash outflows. And one more thing what I would like to say here is, what is the rule of NPV? If you follow NPV method, and if you want to take decision based upon NPV method, if your project's NPV what you are going to find is positive, then the project is an acceptable project. That means you can accept the project if you get positive NPV. Okay, now all this what we have discussed theoretically, I am going to solve that practically over the screen. Please understand. These are the cash inflows for the future. That means first year end I'm going to get $10,000. Second year end I'm going to get $20,000, $30,000, $40,000, $50,000. My expected return from this project is, let's say, 10%. That is the discount factor or cost of capital or required rate of return. See, required rate of return for the investor is cost of capital for the company, and this acts like the discount factor. That means the future cash flows what you are expecting at the end of the year will include your returns in that. Okay, so we will take discount factor at the rate of 10%. So 0.9090. I'll again write it how you get the 0.9090. 1 divided by 1 plus 0.10 whole power 1. Okay, 0.8. I'll just calculate this. 0.8264, 0.7513, 0.6830, 0.6209. So I'm solving. I'm going to find out the discounted cash flows. That means the present value of future cash flows. The present value of 10,000, which you are going to receive at the end of first year, is going to be what? Let's find out. 10,000 into 0.9090 is 9090. So 10,000 at the end of the year is worth how much? 9,090 at the beginning of the year. That means if you invest 9,090 at the rate of 10%, it will become 10,000 at the end of the year. Or if you discount 10,000 with 10% discount factor, if you discount this 10,000, if you discount this $10,000, okay, with discount factor of 10%, which is nothing but this one is the discount factor at the rate of 10%. That means I'll write it here. 10,000 present value is equal to future value by 1 plus 0.10 whole power 1. That's nothing but 10,000 into 1 by 1.10 whole power 1. So this is nothing but the discount factor, which is what I have written here, 9090. So 10,000 into 0.9090 will give you this. Okay, so it's similarly we are going to find out the present values of all these cash flows in different years and see whether we are getting positive NPV or not. So 16,528. 22,530. 40,000 into 0.6830. 27,320. 50,000 into 0.6209. 31,045. Now we are going to add all these values and find out the cumulative present value of future cash flows. That means these are all present value of these future cash flows. We're going to add them up. That's called cumulative. So we'll going to add this. So I got $106,522. So this is my present value of future cash flows. So my NPV formula was present value of cash inflows, which is this $106,522 minus present value of cash outflows, which is $100,000. And I can clearly say I have definitely recovered whatever I have invested and I have surplus of $6,522. That means my NPV is 6,000. Anything if you subtract, you get the net value. So my net present value is $6,522. It is a positive NPV, what we are seeing here. Henceforth, this machine which I bought and I have put that into production process has been a successful or acceptable project. Okay, so please have note down all this. Your NPV is done. We can move towards IRR. Okay, we'll discuss some advantages and disadvantages of NPV as well. Come on, please have a look to this. I'm waiting. Who you have to tell me when you are done with this. I'll give you one question to solve. Please, huh? I'm waiting.
Sure.
Yeah. Please inform me. Okay. Who have you finished? Hello. Hello.
Yeah, sure. Just a minute.
Okay, you're still doing? Okay, okay.
Yeah.
That's a big question. I can understand.
sir.
Okay, fine. So Hoor, I'll give you a question and I want you to find out the NPV of this question. Come on, can you do this?
I'll try to do it, sir.
Yeah, sorry. You will do as a homework, you say, or you will do right now?
I'll do it as a homework, sir. You can continue.
Yeah, okay. So this is NPV question, can be done easily. You know, like there will be a cash outflow and there will be inflows and there will be discounting. You'll be getting discounted cash flows. And then you add this all inflows minus outflow can give you the NPV. Okay. It's positive, it's acceptable.
Okay, sir.
This is also homework. Let's discuss the IRR question. The last and final method. Before that, we will understand some of the advantages and disadvantages of NPV. See, with NPV being positive, you can accept the project. It's an indication. Positive NPV projects can definitely maximize the shareholders' wealth. Okay. This particular method of NPV takes time value of money because we have taken discount factors. It is based on cash flows which are less subjective than profit. See, cash flows are considered in this particular methods, not the accounting income or any kind of accounting profits. Shareholders will benefit if a project with a positive NPV is accepted, that we have already discussed. But one of the problems is what should be the appropriate discount factor or discount rate or required rate of return or cost of capital is a very it's a very tough task to estimate. Why? Because if I say that I expect a return of 12%, why not 14? Why not 15? Those kind of questions have no answers. Okay. So appropriate discount rate is very tough to estimate. For simplicity, cash flows are sometimes all assumed to occur at year ends. So what happens? We have taken in the NPV method, we considered that all the cash flows are like received at the end of the year. That is the basic assumption, but it is not the case. You may receive cash flows in between the year or during the beginning of the year. That can be the case. Some managers are unfamiliar with concept of NPV. That's not good. Why? Because only a financial manager understands this particular method technically. Others have no idea. So somewhat, this is a puzzle for many of the people who are new to the world of finance. Even the investors also do not, even the investors properly don't understand the positive NPV or negative positive NPV rule. Why? Because investors like engineers, doctors, or in fact let's say some of the professionals who are not from the world of finance or who do not have the knowledge of finance, they want some figures like how much returns a particular project is giving, like 15% or 20%. They don't understand this positive negative kind of things. You understand what I'm saying? Hello. Yeah. Now let's go to the next concept, which is the internal rate of return. And I'll put a statement right now in front of you. See, the previous question was like, I invested $100,000 and I expected some cash flows of 10% of 10,000, 20,000, 30,000, 40,000, 50,000. I have got this cash flows. Can you give me a second? I'll drink some water and come. Just a second. Now, so we did the same question, na? We did the same question. Now I'm asking you to do something for me. In this question where I calculated the NPV, okay, I got a positive NPV, that is 6,522. With this, what I understood is, if my discount factor is 10% or cost of capital is 10%, I'm getting a positive NPV. That is 6,522. If I take what? Let's say if I take a discount factor of 8%, will I get positive NPV or negative NPV? Please tell me. Hello? Hello? I'm asking a question. If I do this same question with 8% return, expected return, I'll get positive NPV or negative NPV? I'm asked, sorry?
Negative.
Positive. You said negative or positive?
Negative also.
No, positive. Why negative? See, if the discount factor is 10%, the discounting has happened more. If the discount factor is less, that is 8%, the discounting will happen less. That means less amount would be deducted from these cash flows. Are you understanding? So that will give me even more positive cash flows. So you should do practically these kind of things to understand the concept more properly. So we will do a small small exercise in this. Okay, we'll take 2-3 things here, same cash flows, and we'll do this question and understand what is the concept of IRR, not from the books but practically. $100,000 is what I invested. $10,000 first year cash flow, $20,000 second year cash flow, $30,000 third year cash flow, $40,000 fourth year cash flow, $50,000 fifth year cash flow. So discount factor at the rate of 8%. I'll take some 3-4 rates. Okay, already with 10% I have done. I'll take discount factor at the rate of, okay, I'll take the discounted cash flows here, and then I'll take discount factor at the rate of 14%, let's say. Okay, and I'll take discounted cash flows. Okay, and see what is happening, and I want to prove something to you. So I'll put the discount factors here, need not worry. So 0.9259. 0.8573, 0.7938, 0.7350, 0.6805. Okay, these are the discount factors. Now we will multiply and find out the discounted cash flows. Now we'll take discount factor at the rate of 14%. The cash flows won't change. So how am I getting this? I'll write once again, 1 by 1.08 whole power 1 will give me the first year discount factor. 1 by 1.08 whole square will give me second year. And how I got this 1 by 1 plus r whole power n. 1 by 1 plus 8 by 100 is 1 by 1 plus 0.08. So 1 plus 0.08 is 1.08 whole power 1 in that way. Okay. So you can do that, then whole cube, then whole power 4, then whole power 5 for 5 years. Now we'll multiply this and this factors. So let's add this. We are getting 1,13,644. So what did you understand when you are discounting with a smaller discount factor, or if your cost of capital is less discounting will happen, because when I discounted with 8% as my factor, I got the cash inflow as 9,259, whereas when I did at the rate of 10%, it was 9,090. You can check here, and 9,090 is less than 9,259 something which I got right now. Am I right? See, it was 9,090, which was like very less amount than 9,259 which we got right now. So when the discount factor is less, which is 8%, less discounting is happening and more cash inflows. When the discount factor is more discounting happens and less cash inflows. In fact, we can check this difference in case of 14% as well. So see 8,771. So for 10% in the first year it was 9,090. For 8% it is 9,259. For 14% it is 8,771. So what we see is a higher discount factor, more discounting, less cash flows, less discounting, more cash flows. Okay. Fine. This was the base. So higher and lower cash flows, higher and lower rates we have taken. Now let's do the total for this. Yeah, we got 94,051. So what we are doing here, you should understand in case of IRR. See, I write the definition of IRR. IRR, the cost of capital or discount factor at which the project NPV is exactly equal to 0 is the projects in the sense that discount factor or cost of capital is the project's IRR. Okay, so what we are understanding here is Here we are getting a positive NPV. Of course, why? Because we invested 100,000 and we are getting 1,13,644. Here even we took investment as 100,000, but we are getting the total of cash inflows is 94,051. Definitely our investment is 100,000 and what we got, the total is less than 100,000. So here we'll get negative NPV. Okay, here we'll get positive NPV, but we want NPV as what to get IRR? NPV as, hello, what we should get?
0.
0. That means the cost of capital or discount factor at which your NPV is exactly equal to 0 is nothing but your IRR. So at this rate of, or at this discount factor of 8%, I am not getting 0 NPV. I am getting positive NPV. With this discount factor of 14%, I am still not getting 0 NPV. I am getting like negative NPV. How I can say that? Here the positive NPV is 13,644. How I got? 1,13,644 minus 100,000. And here like I'll just do the difference. So I will get negative NPV of 5,949. How I got? Present value of future cash flows 94,051 minus 100,000 will give me this. So now my question is, what is the discount factor or rate or cost of capital at which I will get exact 0? To find out that, you have the formula of IRR. So we will take that formula here and find out our answer and also the proof. Now let me see the formula. The formula is this. Okay, NPV at higher rate. So NPV is the NPV calculated using discount rate A%. So there is one lower rate and one higher rate. So A is the discount rate which provides the positive NPV. Okay. So one is at the higher rate, one is at the lower rate. So in our example, the higher rate was 14%, lower rate was 8%. So we got an NPV with this, we got an NPV with this. So we'll put them here and try to find out our IRR. Okay. Now we'll just take the NPVs and do our calculation. So our NPVs were 13,644. I'll just note it down. Or let's write down the formula here itself. That makes sense. And then I'll give you the activity to do question at home. Let me write the formula. IRR formula is A. That means the cost discount factor at let's say the lower rate. Okay. And like B. So here A is the lower rate and B is the higher rate. So lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. So we'll do this here. So we'll take, in our example also, the lower rate was 8% and the higher rate is 14%. See, you will get the answer now. 8 plus, what is NPV at lower rate? 13,644. 13,644 whole divided by 13,644 minus, see this will become positive. Why? Because you have a negative value here. So minus 5,949. So minus of minus will become plus 5949, okay, into, then the higher rate was 14 minus lower rate was 8. And if you calculate this, what answer you are getting, please tell me. I'm waiting. So 8 plus 13,644 divided by 19,593 into 6. 13,644, 19,593 is 0.696 into 6. 4.17, 8 plus 4.17, almost, it is like 12%. So 4.17 is 4. So this is the rate or discount factor, which is nothing but your IRR. And at this discount factor, if you find out the NPV of this project or the cash flows, if you take, your NPV will be exactly equal to 0. And let's do that proof. Okay. So let's wind up this concept now. 100,000 is what you invested. 1, 2, 3, 4, 5 years. 10,000, 20,000, 30,000, 40,000, 50,000. Let's take the discount factor 12% because that is what was our IRR in the question. So I'm writing the discount factors here. 0.8928, 0.7971, 0.7117, 0.6355, 0.5674, and let's multiply, find out the discounted cash flows. So it was 10,000 into 0.8928, that is 8928, and 20,000 into 0.7971, 15,942, 30,000 into 0.7117, 21,351, 40,000 into 0.6355, 25,420, 50,000 into 0.5674, 28,370. We'll add these all cash flows. See, I have not taken 12.17 something like total values. So I may get some very nearby values to 0, exact 0 if you want. You have to do that in the Excel sheet with exact figure of 12.17 something which we got. So 12.17 something. So we are not considering the decimal ones. Why? Because it's tough to get the discount factors if we take decimal values. So 8928 plus 15,942, 21,351, 25,420, 28,370. So I'm getting 100,011. So $11 doesn't matter when we speak in 100,000s. So exactly my NPV would be what? 100,000 minus 100,000, correct? 0 or not? Please tell me yes or no.
Yes, sir. Yes.
So my project's IRR is what now? Proved or not?
Yes, sir. Yes.
Now this is the rate at which I am able to break even or not. How much I invested I have recovered or not? Please tell.
Yes, sir.
That's what this says. Okay. So this is the rate at which I have break even. That means I have recovered what I invested. Finished. Please go through all these things right now once. This is the proof. Also, I have done. I'll show you that. Once have a look at this. Then when done, tell me. I'll also show you the proof and IRR is done. Okay. Come on. I'm waiting.
Sir, but why shouldn't IRR be positive? I mean, NPV be positive?
See, if NPV, that is the rule of NPV. If NPV is not positive, you cannot accept the project. So any particular method runs on some assumption, na? Hello.
Yes, sir.
See, why sun rises from the east? No one has the answer for that. That is the nature. In the same way, NPV method, like it works or runs on certain assumptions. And the NPV's assumption is what? Whatever we have invested here and whatever the cash flows which we have generated, we have something in our mind that we want some returns in the future. Taken into consideration those returns, the time, because this is a time value of this IRR also follows time value of money concept. So we have discounted the cash flows, IRR or NPV as well. Both the methods follow time value of money concept. So after discounting, we got the present value of this 10,000 as on today, 20,000 as on today, 30,000 as on today. And we added up all these cash flows. See, if you total them without discounting, how much you'll get? 10, 20, 30, 30 and 30, 60, 60 and 40 is 100, 150 is 150, correct? So, but we discounted and we got the present values as on today as how much? 113. So as on today, what we invested, we are getting more than that. So we will accept or not?
Yes, sir.
That's what it means. That's it. So hence the difference gives a positive value. Positive value is always a positive indication. That's what. Naturally.
Sir, for the 12%, when you took 12%, there's no profit also, no loss also. So,
Yeah, that is
is
break
this
even.
better?
That is IRR. IRR is break even. See, now once you come to know the IRR of the project, you can, any project if you want to invest is giving you, let's say, 10% less than IRR. This kind of projects you can take up. Why? Because at 12% your NPV is what? Hello.
0.
At 10% your NPV will be less or more?
More.
Why more? Because this is a smaller discount factor and less discounting will happen. Less discounting when happens, it can give you positive NPV. And if I take 15%, let's say, it will give me negative NPV because higher discount factor, more discounting happens. More discounting happens, more value gets reduced. Okay. So more and more value gets reduced will pull this to negativity or negative values. So here you'll get negative NPV. So this you cannot accept. You can accept only the projects which are giving less than the IRR. Are you understanding what I'm saying?
Yes, sir.
After the class, you again listen the video and then you try to do. See, I have experimented as well. I have done the experiment also in front of you to prove you things. So that's what. Any doubts? Please ask me. I'm ready to clarify. Any more doubts? Further doubts?
Yes, sir, done.
Okay, see this proof as well. Okay, the formula, have you done this formula as well? The calculation part. Hello.
No, sir.
Okay, do this. And afterwards we will go for the proof part.
Sir, can you scroll a bit down?
Down. Okay.
Yes, sir, done.
See the proof also. And this also I explained now. This was your IRR. If less than that, if the discount factor is, if any project is giving you less than that, accept it. More than that, reject it. Why? Because here you get NPV as negative, NPV as positive. See the proof, and the proof is also in front of you. I took the IRR and I got the exact NPV as 0. Check the proof as well. 2 minutes. Minutes. Have you finished?
Yes,
Hello.
sir.
Yeah. So hopefully both of you have finished now. So what we can do is we are done with NPV and IRR, but some more discussion can be done. So this is homework for you. Okay. IRR question is homework, but like we'll understand about the advantage and disadvantage of IRR before closing this. So all projects with greater IRR than company's cost of capital. So I have taken the cost of capital as 8% and the IRR was 12%. So this is acceptable. Okay. But if the cost of capital is 15% and IRR is 12%, this is not acceptable. Did I say the same thing? Hello.
Yes.
Hello. We discussed the same thing right now. Yeah.
Yes, sir.
Will give you positive NPV. This one will give you zero. This one will be giving you negative NPV. So won't accept this. Advantages and disadvantages of IRR. It takes time value of money. Results are expressed as simple percentage. Very good. But if you have unconventional cash flows like 10,000 is a positive cash flow, 5,000 is a negative cash flow, 20,000 is a positive cash flow, 8,000 is a negative cash flow. In this case, you can have multiple IRRs. That means if I make a diagram of IRR, it will look like this. Okay, here 7%, here 35%. So two kind of IRR I am getting when we have an unconventional cash flow. So decision making becomes very, very controversial. So this cannot be trusted. So what is the most trustworthy method? NPV. Okay. And it may give conflicting recommendations with mutually exclusive projects because the result is given in relative terms. This point I will discuss tomorrow with the help of an example. It may seem to you as a very small point, but it is not like that. Why there is a conflicting conflicting recommendations, I will explain you tomorrow. Okay, so it may give conflicting recommendations with mutually exclusive projects. Mutually exclusive projects are those projects out of two you have to pick one. Okay, so percentages can mislead you or misguide you. So for example, okay, let me prove this. You have invested $10,000 and the IRR or the returns what you're getting or at the rate at which you will break even is 10%. You have invested $5 crore, okay, and still the returns what you are able to break even at 10%. Which is a good project? Come on, tell me. Which is a good project? See, here also the break even will happen at 10%. Here also the break even will happen at 10%. Which is a good project? Hello? Hello?
The second option.
Sorry?
The second option.
No. How will you decide? Both of them are giving you the same kind of returns now. In the sense, at the same rate, you are able to break even. So which is good? We cannot decide that. Nothing seems to be better now. Both are giving the same kind of returns. Correct or wrong?
Correct, sir.
So that's what it is. It's a big problem for deciding which is a better project when you have mutually exclusive projects and you have found out the IRR, the rate at which both the projects will break even, and those are similar. So we cannot decide which is a better one and we cannot pick any one of them. But if this project gives you a positive NPV of, let's say, $300, and this can give you a positive NPV of $100,000. Definitely this is giving you more. Am I right? I understand you're putting a very high amount. Okay, let's not go into something. You have just invested $11,000. Let's say. So here you are getting $400. Or let's say if this is also $10,000 and you're getting a positive NPV of $400. Which is better? The 400 one, correct or wrong? Hello?
Correct, sir.
Simply we can decide because it is giving more NPV to us, more value to us. Okay. This is a homework. Now we have only one topic, relevant costing. This is the sixth topic. I want 20 minutes of time tomorrow. Because we have to do a question also. So we will take just 20 minutes tomorrow to finish and then we will immediately start standard costing. That's okay, na? Hello?
Yes, sir.
Or you want me to continue because again it will take half an hour. So I'm already I am also about having some other session right now. So only some 20 minutes we'll spare on this, and then we'll immediately move to standard costing. Okay, next chapter. Okay, fine. Thank you.